Tim Marshall, in his book titled Prisoners of Geography back in 2016, and a subsequent sequel, argues about how some countries stand to gain and some countries stand to lose over the course of the next couple of decades. Now, people have added various aspects of geoeconomics, geographical benefits to this argument. And one of them who kind of looks at investing from multiple lenses, including this, is Ramesh Damani. And in his few recent conversations, unless I'm very wrong, Ramesh has argued that for reasons beyond just earnings power, India may stand to gain, and therefore Indian investors or people who invest in Indian markets might stand to gain. I have him with us on the show today to try and understand how is he thinking about the markets from his vantage point currently. Ramesh, great having you as always. Thanks for talking to us.
Neeraj, it's always a pleasure to be on with you. Thank you for having me, actually.
No, and please correct me if I'm wrong, but are you of that belief that India, by virtue of multiple reasons, let alone just earnings power, is the place to be?
Yeah, Neeraj, it's actually interesting. I mean, if you ask me, do you follow the macro, the micro, I will always tell you it's the micro. And I firmly belong to the Peter Lynch camp that if you spend 10 minutes on macro investing, you're wasting your 10 minutes out there. You better do bottoms up focus on the company, which is what I've done all my life. But I think we are in a special point in time and place in India, and maybe because Indians, we see the opportunity better than you would have seen it if you were, say, in Australia or even Africa. That means, and what the macro allows us to do is to hold through these periods of disappointing earnings, a poor earnings cycle, a bit of gloom and doom in the market as we are talking right now. And that point is that the last 3 years, the budget, for example, was focused on the pandemic and the recovery from the pandemic. This was the first post-pandemic budget that the finance minister would give. And this is the central legacy, not legacy, but central policy question that the framers in India and New Delhi face, that there are two Asian rivals, China and India. And how does India, in 1980, India used to be 64% of China's GDP. Despite a rapid growth in the 2000s, we are now at 17% of China's GDP. So you're lagging behind there. But let's fast forward to the future. What's going to happen in the next 20, 30 years is that India, that currently has about 350 to 4 million people below 14 years of age. China has almost 120 million less than that. So as in the next 7 years, they come into the workforce, what kind of policy response do we need to make sure they're employed and make sure that they are, citizens of the world community, if you will. Now, India's been very lucky to build a world-class cyber and software business out there. But that can only employ a fraction of the people that we need employment for. The 360 million people who cannot be employed in by logic in the security and the software service. We need manufacturing. So that's what you found in this budget, a whole emphasis on capex, a whole emphasis on manufacturing. A lot of people have been very disappointed with the Indian market because there's been a lot of foreign portfolio selling in India this year. Say people are selling, they're bearish in India. But the stat that some observers have pointed out, and I think it's more important to look at, is the FDI. And the FDI has been booming every single year. There was a talk by Mr. Deepak Baghela who pointed out a very interesting stat. He said, since independence, India has got about $950 billion of FDI. But almost half of that have come in the last 90 months. And it's come in a variety of industries, a variety of states, and it's been increasing every year for the last 5 years. That points to a resurgence in manufacturing, or points to a resurgence in economic activity in India, that we're creating a whole new aspiration class. So what the government has been trying to do in this budget, and why the macro is important, is that we look at the big picture number, that by 2045 or 2050, India will have 250 million people more than China. And if demographics is destiny, we need this kind of people, and that required an awesome amount of growth in India. So the macro allows you to hold on to stocks through what we're going through is a slightly bearish phase, slightly doomsday, some corporate troubles go and so forth. Because as the old saying goes, you keep your eyes on the prize. And the eyes on the prize is India at 2050 or India at 2075. You want to look India at 100, how will it look like? I think if you look at that, then the macro allows you to hold on to those stocks.
Interesting. And so within this construct, Ramesh, I'm sure the variables are materially different in that India probably looked very promising, let's say maybe coming out of the 2008 crisis as well, if you will, because the growth of the young India, developing India was always there. But some businesses, consumer businesses, did really well for the decade. Some businesses, manufacturing, did not. How are you looking at the landscape in that sense? Because not everything will gain. So, what would be the first amongst equals, so to say?
That's almost a very, very difficult question to answer, but I try to do that. My job is to allocate capital, and I think
Precisely.
we tend to do that. Uh, the first rule is you need to be invested in this country. That's the first rule. I think over a 10-year period, okay, the Sensex always delivered positive returns. Okay, it can be very volatile over a quarter, very volatile over a year, very volatile maybe a couple of years. But if you remain invested in high quality businesses, I don't think there's a 10-year rolling period in which you could have lost money in the Sensex. So the first rule is you remain invested. Now, what do you invest in? That's a more difficult and more challenging question. But we tend to stick with the favorites, whether they're consumers, some new age economy, some technology. Uh, we have some new themes that maybe we'll talk about later in the interview. But my first rule is that people will try and time the market, and try and get rattled or shaken out by the falls that will happen periodically. That's the nature of the beast, Neeraj. Markets will always be volatile. You cannot avoid that. You cannot get linear returns in the stock market. Returns in the stock market are lumped together, and you need to understand that and you prosper in that environment.
Sure.
So my first rule to people is, before you're talking about where to invest and what to invest, that's obviously great businesses with cash flow. That's what you want to invest in. But the first is remain invested. You must devote a portion of your equity to equity investing.
Sorry, what I meant to actually ask was, and I'll come to themes a bit later in the interview because there are a lot of other macro things that I want to understand from you, despite you say that you are the Peter Lynch camp. But what I meant to ask, Ramesh, maybe was that if we saw the previous decade, just 2011 to 2020, it was largely a consumer decade. B2B didn't do as well at all. There's a lot of talk about how whether now, because of the focus on manufacturing, infrastructure, capex, that this could be a B2B decade and not as much a B2C decade. Now, because you are a B2C fan, I'm tempted to ask you, how do you think about this argument?
Neeraj, I'm first a fan of buying stocks cheap.
Okay.
I don't really, the B2C were cheap, so we bought cheap. The PSUs were cheap, so we bought PSUs. I'm really a fan of buying stocks on a knockdown valuation, because that's almost a guaranteed way to make money in the stock market. So I think we have to go through, as you say, bottom-up stock picking, see which sectors look cheap to you. I mean, a lot of money has been made in the last year on PSU banks, which are the most hated stocks, because it got to a point that was, significantly cheap. Markets will tend to do these things in extreme. Will take, say, a Tesla or a Netflix at some point to some crazy valuation, and then bring them down to earth. And at one point, if you recall famously, that the S&P Energy was less than a couple of percentage points of the S&P 500. And today it's back to 10-20%, and the market cap of Berkshire and Exxon has overtaken a lot of other new tech companies. So, I mean, the first rule is not necessarily B2B or B2C. I mean, that may well be, but the first is to find stocks that are cheap. As my mother used to say, "Rupi ki cheez thandi mein chahiye." You want to buy things cheap, and I think that doesn't change. If that changes the stock market, the concept will be over.
Okay. So, do you reckon that as a basket, India is currently a रुपए की चीज ₹1.25 में मिल रही है, or is it fairly valued? Also, in light of the fact that this whole trial balloon around peak rates and then a cut for now has been punctured, so that argument kind of hurts equity valuations per se.
Yeah, I mean, someone put in a headline very nicely here. He says that the unstoppable markets till last week had met the immovable Fed, and guess what? The Fed won because of the threat of a rate hike. The market is now taking that very seriously. But again, the risk of that is you're focusing on the next quarter and the next few months ahead, and yeah, that would make me nervous, clearly. But like I told you, for this time, I'm focusing on the bigger macro picture in India, and that picture tells me that we're going to have, I don't know, 1.65 billion consumers in the next 20 years. We're already the most populous country in the world. It's a well-established fact that demographics is destiny in this country, or in any country as investment. A lot of countries are going through, harakiri in terms of population. So I think the first point, and I'm repeating the point to you, is that I believe that it's a long-term structural bull market that's unfolding in India, and you'll obviously go through many ups and downs. But the key thing is to keep, as I told you, quote unquote, eyes on the prize.
Got it.
That is what India will look like in, say, 2047.
Wow. Okay. Um, so just before I probe that, just one quick short-term question, Ramesh, before I move on to the price and how are you thinking about it? Um, the last couple of quarters, or maybe the last 3 or 4 quarters, if you will, due to various uncertainties all coming together, we've seen even managements not quite have a complete hang of what will happen in the near term. And therefore, sometimes the disappointments are writ large on the way the market punishes when even honest companies which have come out and not met guidances or not quite lived up to what they had spoken about are getting punished. So my question is, when you look at this, how are you thinking about it? Because it may have happened in some of the companies in your portfolios or some of the companies that you are tracking, wherein companies are not quite able to live up to what they've spoken about.
Well, Warren Buffett put it best, better than I can at least. He said, in the short run, the market is always a popularity machine, a voting machine. But in the long run, it's a weighing machine, right? So a lot of people will get disheartened by a particularly bad quarter or a poor earnings cycle and, sell the stock. And sometimes that's a huge mistake because, as I said, you're looking at a market opportunity 5, 10 years down the road, not necessarily the opportunity today. And part of that is some pain. I mean, you have to feel some pain in the stock market. Either you feel the pain by buying now and having the price go down, or buying at a much higher price 5 years down the road when things perhaps are a bit clearer to you in the financial market. So yeah, a lot of, but the sense I get overwhelmingly, you may get the sense from a few corporates, overwhelmingly is that there's an underlying bullishness in management about the structural reforms that are undertaking in this country. You can see that by the number of FDI told you, the number of unicorns that India is popping, and the number of new business startups that we are doing is not even close compared to, say, what some of the other countries are doing, because they can see the opportunity. A capex cycle revives only when you feel the opportunity ahead is greater than the opportunity today. So, I don't know which audience we particularly zero in. Yeah, there may be some people pessimistic, but generally the feeling I get, the undertone I get is that they see a great opportunity, a great market in India over the next 10, 20 years.
You invoked the word capex 4 times already in this conversation. I'm inclined to ask you, how constructive are you about this whole capex theme, the beneficiaries out of capex, and the overall impact that such a thing has on the economy, growth, jobs, so on and so forth?
It is, because we need to have manufacturing. Though personally, if you ask me, I'm more of a new economy believer. I believe, for example, in the digital stack in India, and the new economy doesn't require a lot of capex. It requires some computers, some concrete to build a house, some wires, and you're up and running out there. And one theme, and just to get to a theme to explain to you, a lot of press has been said about data being the new oil in India. There are a lot of people who use data now. A lot of people in India that are already using data, whether it's, say, building maps or doing reservation systems, or just doing knowledge analysis from the data, or just aggregating the data. So there's a plethora of companies already in India that are doing that. What I found interesting in some of these companies is that their employee cost to revenue is about 60 to 65%. Extraordinarily high, 65% of the employee cost to revenue, which tells me two things. That first, this business is all coming to India. This business cannot be done in Europe, it cannot be done in America anymore, because the cost of recruiting, if you can find the people there, would be so high to not make it productive. So the business is coming to India. So those are the kind of new age companies that you want to be in for the new generation of technology business, for example. I don't know, maybe the old technology businesses don't deserve a high PE now because the service business is gradually scaling. But these intensified knowledge BPO companies, you get cheap real estate in India, telecom costs are the lowest in the world, and plus you get enough manpower to do these jobs. Even at that, you're running at 60, 65% cost. But this cannot be done competitively almost anywhere in the world. So those look like good places to see, like data companies, for example, in a spectrum of businesses. It's, health processing, it is map making, it is hotel online reservation, it is people who do analysis for you on your data itself, or people who aggregate data and send it to, uh, more sophisticated players who can analyze that. So across that spectrum, if you're asking for a new opportunity, I would see that. Do I believe in the manufacturing story? Yes, I do believe we necessarily have to, do well in manufacturing. If India has to succeed in employing those 350 million people who are going to be coming of age in the next 7 to 8 to 10 years, You obviously need a manufacturing base to do that. And we look, I think a lot of the stocks that we held for years have actually done well, compounded over periods of time. Again, not recommending it, but the Tata Honeywells of the world, the I forget if you're the Lakshmi machine, what's the word? We also saw they keep compounding as well. I'm not sure where the next opportunity will be found necessarily in terms of sector, but in terms of a new sector, if you're asking me, that's what I'm looking at.
Very interesting. The were you a tad disappointed with the way the whole flux happened around the new age internet businesses getting listed at premiums, moving higher, and then suddenly seeing a large collapse, and this whole shaking up of confidence that happened around that, because it was a sector that is getting formed, and suddenly there was this whole loss that's happened to investor fraternity.
I think they got greedy. I think they came out at the top of a market at a very bubblish valuations. Like I told you earlier, the trick in the stock market is रुपए की चीज ठंडे में खरीदने का, वो रुपए की चीज ₹1.5 मिल रही थी. So we were not getting the great bargains that we were associated with. Having said that, the most important thing to understand about the new India is that the digital stack that India has built up, the UPI payment transfer that's taking place out there, it's one of the greatest transformational changes that is taking place in this country, all before our eyes. So we're not capturing the entire magnitude of the change that is taking place. So if you're going to have, I don't know, 600 million, 800 million internet users in India, 95% are going to have an access to a smartphone. 95% is going to have the cheapest data in the world. They're going to use the phone and the net very effectively to order food, to buy insurance, to book real estate deals, to book hotel deals. So you cannot ignore these companies because that is the way the businesses will be transacted in the future. So the question then to ask is, have some of the businesses, the valuations come down enough to make it interesting? You can't value it on brick and mortar businesses. You can value it on intellectual property, the software, the algorithms, the logistics issue. And I would suggest to you that yes, they have come down in valuations, and that maybe I don't know if you have the courage to go whole hog at this valuation, but look at the big picture: 800 million Indians with a smartphone and cheap data plans. How are they going to order food, order books, order groceries? A lot of them going to do it through the net. So you cannot afford to ignore that marketplace. So we have started making nibbling bets in what you call the new economy stock. The problem, the disappointment was, Neeraj, as you correctly pointed out, they just came out as stratospheric valuations that made no sense, given what the likely trajectory was over the next 3-4 years. But now look at the trajectory of the next 10 years or so. I think you're beginning to see the emergence of some more sensible valuations.
And at the same time, Ramesh, you're also straddling the sphere of, let's say, PSU stocks, some of which, I mean, I don't know whether it's PSU banks also, they've been beaten down in the last one odd month, but which are not necessarily as digital and tech savvy as some of the private players are. So you're doing an interesting mix of value buying versus a long-term futuristic buying, so to say.
I mean, like I told you, my first criteria, Neeraj, is always looking for stocks that are cheap. I mean, I'm pretty much agnostic, and I get actually a bit peeved when a lot of analysts come on your channel, other channels, and says, "Oh, don't buy PSUs." I mean, that seems like a ridiculous statement to make. I mean, in the stock market, your job is to discover valuation. Now, there are bad PSUs and the good PSUs, and there are also bad public sector companies that have gone bust. I can name you any number of examples, and the good sector. And the trouble that a lot of people make is that they club all the PSUs together, whether it's commodity, whether it's telecom, or whether it's actually defense and railways. So clubbing a lot of bad and good companies together and coming up with a result that justifies your expectation, as opposed to doing stock picking. I've said this many times before, I'll repeat it. I used to own a stock called Bharat Electronics. I still do, so I'm not recommending the stock. The stock was in 2000 maybe at a 400-500 crore market cap. It's 60,000 crores today after paying handsome dividends along the way. It used to be at 5-7% yields for long periods in its time. Never diluted the equity and produced great business. And in the high tech, the kind of businesses they do, they have a moat around them. Nobody else in India at this time can do the kind of electronics work they do. Almost, if you want voting, you need their machines. If you want defense, you need their machines. If you are an Air Force pilot, you need their radars. It's almost a critical business. So in the same span, a lot of businesses in the defense and the railways that we're looking at are absolutely critical pieces over the next 10 years. You want to fight China, for example. You always think of a land war with China. But now you realize you have a huge peninsular coast. A lot of the traffic between China and the rest of the world flows through the Malacca Straits. So how do you fight them? You have to have a sea power. You have a presence in the naval field. Who does that? So you have to ask yourself these kind of questions. If you're going to be a geostrategic player and China and India are going to be at each other, you cannot afford to give them complete and override control of the Malacca Straits. You need to engage them maybe in the Himalayas, but also in the Malacca Straits. And there are only 5, 6 shipbuilders in India who are capable of building the destroyers, the aircraft carriers, the frigates. They need to take on that challenge. So I think there's a good opportunity. We found these stocks, in my opinion, at throwaway valuations. I think some of them have been re-rated, but I still believe that there is a ways to go, perhaps.
Have railways been completely re-rated? Because after a really long time, you hear this, you see the spring in their step, you hear the optimism in their voice, you see numbers in their order books which are much higher. But these are stocks that have perennially been shunned because they've flattered to deceive a number of times.
I don't know why they've been shut. I mean, I've gone through each of them. The order books are maybe 5 to 7 times the
Yes.
sales. They pay you a dividend yield of almost 5 to 7% on the current stock price, and they've been reasonably consistent in producing, good set of numbers. So, and if you look at the market caps to the opportunity size, they seem a bit puny to me. So I think sometimes a person's despair is my opportunity because I could sense the opportunity there. I still think that some of those businesses are very attractively valued. These are irreplaceable businesses, and you're getting them at, I think, at really good valuations. So I would hold on to them. I'm not really particularly concerned that they have a PSU tag. There are capital allocation problems. Of course, there are needs out there. But if you believe in a changing India, you believe in digital governance, you believe in this, even they will change over time. And where do you get a blank check in private companies that are well managed? I mean, I just find that that hypothesis is a bit outdated.
Okay. I have last couple of questions. My final question is about how do you, maybe using a past example, about how do you think an opportunity 10, 15 years out? But before I get to that, just one quick follow up, because you're such a entrenched capital market person. The last 2 or 3 years, we saw a very large proportion of Indians entering the capital markets. Maybe COVID aided it, what have you, but I think the digital stack has also aided it. Uh, and there are a bunch of businesses that have come out of there and gotten listed and are available. Now, the way you spoke about how smartphones, everybody would have that, and therefore that's an opportunity. Our capital market plays, because so many Indians over the course of the next 10 years will invest, our capital market plays, brokerages, AMCs, wealth management companies, a play to consider.
I mean, it's pretty obvious that they are places to consider. Now, will the traditional broker, face uh, a problem in a competitive environment because you're now moving to a digital player? Yeah, they will face a player out there. What the regulatory environment says against holding demat holdings, I'm not sure about all that. But I think this is a long-term dream that instead of having 3, 4% ownership of equity in terms of the population, then move to 15 to 20%. I don't want to make the numbers before you. I think the numbers will be astounding. It's just because India is blessed with 1.4 billion people. The numbers can be astounding. What are the alternatives that Indians have? Indians used to invest in gold. Here's a news flash. Inflation was at 40-year highs and gold was down last year. Okay, it's not keeping up with inflation. So it doesn't seem to be where you want to invest. Real estate, the ticket size keeps increasing. You have 5,000 rupees a month, 10,000 rupees a month, you want to invest. Please welcome to the stock market. That's the best, safest place to do it. You don't want to buy stocks, buy an ETF that tracks the Sensex and Nifty. That's absolutely fine. But these are going to be gigantic, ginormous markets over long periods of time. So I would say it's certainly A, invest in India, and B, if you invest in India, you can also look at the infrastructure people like you're mentioning, the insurance company, the depository, the brokers who win in this. Why not? They all have a good growth ahead.
Okay. Ramesh, I'm trying this out as the final question. I don't know how well it'll work, but I want you to, if you can, that is, and if you remember, tell us about something that you had invested in some time back, say 10 years ago, 15 years ago, with a thought process of how large it could become in 10, 15, 20 years. I just want to understand the mental model that goes behind thinking about a business 15 years out, because a lot of people are now hearing on television about a lot of experts saying that, hey, invest from a long term perspective, but may not have the right mental model or the yardsticks to be able to do that. Can you help us with that?
Sure, I'll tell you, I think a stock that you're familiar with that I've invested, I think that's probably a good template to understand. Neeraj, I think if I'm not mistaken, 2004, 5, the entire Indian liquor industry was available for maybe 100, $150 million. By that I meant the people who own 50% of the beer market, 50% of the liquor market, and some other companies were available for pennies on the dollar, if you will, out there. Now, if you were stepping back from 2004 and saying, I'm looking at 2024, you could have figured that so many people of India were going to enter the drinking age over a period of time. There's no social ban on drinking as such in India. It's, generally an opener culture, though in some parts of India there are some restrictions, but generally it's an open culture. And one thing, the minute you get a job and you have friends, you want to hit happy hour and have a drink. And I always tell everyone the famous scene in Diwar, where if you remember, Parveen Babi and Amitabh Bachchan are sitting, and Parveen Babi pivots to Amitabh and says, "The शराब भी बड़ी अजीब चीज है, इसे देखो ये खुश है इसके लिए पी रहा है, इसे देखो आज अकेला है इसके लिए पी रहा है, ये गम है." So it's a universal lubricant. I mean, if the bars weren't exist as a concept in Mars, they would have to put bars there because people need a place to get together, to enjoy and have fun. So it's a universal lubricant. It's just unfortunately misplayed in a lot of Hindi movies as, ye sharabi hai or something like that. People enjoy a glass of wine, a tipple or two over drinks, So this is a long-term market that we could foresee in 2004 that as India evolves and liberalizes, this market will, evolve and liberalize over time. Unfortunately, and it has evolved. I mean, the stocks are up 50x, 100x from those times. Can they still double and triple? Yeah, I believe they can. Unfortunately, what has happened is that they didn't come under GST because the states make so much revenue from alcohol. They're not willing to put it under GST. So you're still dealing with 35 different states collection regimes. Some states banning it, some states not banning it. But as you say, I'm looking at India at 2045. I'm not looking at India at 2025. I'm looking 10, 15 years down the road, maybe leaving these shares as a legacy for my grandchildren, as you know. And, I think they will do fine. I think this, so to give you that example, to come back to the example, say every bull market, Neeraj, tells you a story. 92 bull market talked about India's liberalization. 2000 called the tech boom in India, So what is this bull market calling you? It's calling you that we have a demographic and geocentric issues in India. Demographics explained to you. Geocentrics have explained that India and China are going to be rivals for power. That India is going to take on China. It needs to really kickstart a lot of things that are going on, which we are seeing evidence of that happening right now. So I think we look at that point of view. What are the sectors that invest for 10, 20 years? Yeah, I think I told you data would be the new BPO. That would be a sector I would invest in. I invest in a lot of insurance companies because all these companies will tend to prosper in the great boom that we see in the next 20 years. But more importantly, I mean, I'm not trying to peddle any sector or stock to you, Neeraj. More importantly, what I'm trying to peddle is the importance of remaining invested in this country. And you have to ride the volatility. I cannot help that. That unfortunately is a part of the beast. If you had come and invested in India in 92 when I did, we went through multiple crises. We went through Cargill, global financial crisis, the plague, COVID, any number of things out there. But I came with an index of 600. Today it's closer to 60,000. So it's been a great journey. And I think the next 10, 20 years will also be a great journey, provided you remain invested. And if you can't find stocks, you're not busy, buy a tracking fund. That's the easiest thing to do.
The easiest thing to do. No, but this answer was special because it teaches a lot of people about how to kind of foresee things and not get swayed too much by the short term. Actually, this interview was pretty much like that as well. Ramesh Damani, a special thanks for talking to us today, almost at the start of 2023. And may you, at 2047, may I get a chance to talk to you again at that point of time. May that money not be for your grandchildren, may it be for you and for your entire family.
I think we're really cutting it close. I think I'll be around at 2045, but I'll take the good wishes of health anyway. And Neeraj, is always honored to be on your show.
Thank you so much, Ramesh. Really, really lovely talking to you. And viewers, thank you so much for tuning into this very special conversation.